So, I was thinking about this the other day, and I want you to picture something with me for a second.
Okay, I'm picturing it.
Imagine you are, gearing up for a hike, and your route requires you to cross this small, shallow creek in a local state park.
Right. Pretty low stakes.
Exactly. For a trek like that, your preparation is minimal. You grab like a small day pack, you toss in a bottle of water, maybe an extra pair of dry socks in case you slip in the mud, and a granola bar.
Sounds about right.
Yeah, and that backpack basically represents your safety net. If something goes slightly wrong, you get thirsty, you get a blister, you get your feet wet, you're covered. That level of preparation is perfectly adequate for the level of danger you're facing.
Makes sense.
But now take that exact same small backpack with the single plastic water bottle and the extra socks and try to use it to climb Mount Everest.
Yeah, the outcome of that expedition would be completely disastrous.
Yeah.
I mean, you're taking a preparation strategy designed for controlled, low-stakes environment and just applying it to an environment defined by extreme volatility.
It doesn't work.
No, not at all. The ambient temperature, the lack of oxygen, the unpredictability of the terrain, the physical realities of Everest demand a completely different paradigm of preparation.
Exactly. The moment you scale up the danger, the required safety net has to scale up with it.
Yeah.
You suddenly need, thermal layers, specialized ice axes, supplemental oxygen, a team of seasoned guides.
Right.
The environment dictates the preparation, and the risk dictates the required safety net. Which brings us to the core question of today's deep dive.
It does.
If we inherently understand that a shallow creek and Mount Everest require completely different levels of protection for a hiker, why did we spend decades treating insurance companies as if they were all climbing the exact same mountain?
We spent decades doing exactly that because, well, early financial regulation was built on a model of simple barriers to entry rather than, dynamic risk assessment.
Okay, so it was just a flat rule for everyone.
Pretty much. For a very long time, the way regulators thought about financial safety nets for insurance companies was entirely static. They essentially handed everyone the exact same small backpack.
Wow. Regardless of what they were doing.
Exactly. Regardless of whether the company was writing a few small life insurance policies in a single town or, I don't know, covering multi-million-dollar commercial fleets across the entire country.
That sounds incredibly dangerous.
It was. And today we're going to explore the architecture of how that fundamentally shifted. We're looking at the absolute cornerstone of American insurance solvency regulation and exploring the mechanisms that keep the entire system from collapsing.
I love it. So, I want to formally welcome you, the listener, to this customized deep dive into risk-based capital, which you will hear us refer to as RBC throughout this discussion.
Get used to the acronym.
Yeah, you'll hear it a lot. And whether you are currently working through the Insurance Study Companion Series and prepping for a CPCU exam, or, maybe you're an insurance professional looking to understand the mechanics of your industry, or if you're just insanely curious about the invisible financial guardrails that protect the broader economy, this conversation is tailored directly for you.
Definitely.
Our mission today is to take a regulatory framework that often feels like, honestly, an impenetrable wall of mathematics and legal jargon and break it down into its component parts.
Which is so needed.
Right. We are going to look under the hood of the insurance industry to see how regulators actually measure danger, and more importantly, what happens when a company gets too close to the edge.
And really the goal here is to move past rote memorization. I mean, if you can grasp the underlying philosophy of why this regulatory architecture exists, the formulas and the legal requirements just become intuitive.
It's like learning the rules of the game instead of memorizing specific plays.
Exactly. It is about understanding the physics of financial risk.
Okay, let's unpack this. Let's set the foundation. We are talking about risk-based capital, RBC. Who created this thing, and what is the fundamental problem it was designed to solve?
So RBC is a regulatory capital standard, and it was actually developed by the National Association of Insurance Commissioners.
The NAIC.
Right, the NAIC. And to give you, the listener, some context here, insurance in the United States is regulated at the state level, not the federal level.
Right, so there's not like one big federal insurance box.
Exactly. You have 50 different state insurance commissioners.
Yeah.
So the NAIC is the organization that brings them all together to basically create uniform models and standards so it's not complete chaos.
That makes sense.
And the fundamental problem they were trying to solve with RBC was the total inadequacy of fixed capital requirements.
Which goes back to the backpack analogy.
Yep. The core function of RBC is to calculate the absolute minimum amount of capital an insurance company must maintain to stay legally solvent. And this is the key part. It bases that calculation strictly on the specific risks that the individual company takes on.
So wait, let me pause there. Because the idea of a fixed capital requirement actually makes intuitive sense to me as like a starting point.
Oh, sure.
I mean, if I want to open a bank or start a major financial institution, I assume the government requires me to prove I have a certain amount of cash in the vault just to get my license, right?
Right. A barrier to entry.
Yeah, like a cover charge to prove I'm a legitimate player. So a billion-dollar company and a million-dollar company don't just pay a standard cover charge to do business. Why wouldn't a fixed standard capital requirement work for insurance?
Well, a fixed capital requirement functions perfectly fine as a barrier to entry. Just like you said, it keeps out the fly-by-night operators who don't have any initial backing.
Okay.
Let's say a state requires every insurer to have a baseline of $5 million in surplus capital just to get a license. That proves you have some skin in the game.
Right. It weeds out the total amateurs.
Exactly.
Yeah.
But the failure of the fixed capital system becomes glaringly apparent the moment the company actually starts doing business.
Got it.
Because a $5 million flat requirement completely ignores the volume and the volatility of the business being written.
Oh, right. Because $5 million means something very different depending on what you are doing with it.
Exactly. So picture company A. They might be this tiny regional mutual company that only writes basic property insurance for, I don't know, small inland farming communities where nothing much ever happens.
Right. Very sleepy.
Yeah. For them, $5 million is a massive, impenetrable fortress of capital. The odds of them ever needing to drain that reserve are infinitesimally small.
Okay. I see where you're going with this.
But then you have Company B. And Company B writes complex liability coverage for pharmaceutical companies, or maybe commercial property insurance for skyscrapers in seismically active zones.
Wow. Okay. High stakes.
For Company B, $5 million is a rounding error. If a major earthquake hits or a massive class action lawsuit is filed, that $5 million evaporates in an afternoon.
So a flat fee basically treats the hiker in the state park and the climber on Everest as if they face the exact same threats.
It does. It creates this really dangerous illusion of safety. The regulators might look at a massive, highly leveraged company and say, well, they met the statutory $5 million minimum, so they must be solvent.
But they're totally not.
Right. The underlying exposure is completely mismatched to the safety net. And this became a glaring issue in the late 1980s and early 1990s.
What happened then?
There was a whole string of high-profile insurance insolvencies where companies that easily met the fixed statutory minimums failed spectacularly.
Wait, really? Even with the minimums?
Yeah, because they had taken on massive, hidden risks in their investment portfolios or their underwriting practices. So the NAIC realized that regulating a company based on a static number was fundamentally flawed.
That makes a lot of sense. And that leads directly to the core philosophy of risk-based capital. The source material distills this down into a very simple, inescapable equation.
Which is?
Higher risk equals more required capital.
Absolutely.
It moves the regulatory target from a static number to a dynamic, constantly shifting calculation.
And that calculation is focused entirely on one word: solvency. And I need to stress this: solvency is not profitability.
Oh, interesting distinction.
Yeah, solvency is simply the mechanical ability of an insurer to pay all of its legitimate claims and financial obligations as they come due. So RBC acts as a dynamic safety net that recalculates itself based on how aggressively a company is operating.
The source material provides a fantastic analogy that really helps visualize how this dynamic requirement functions in practice. It compares the capital requirement to the safety features on a vehicle. Let's explore that because I think it perfectly illustrates the NAIC's logic.
I love that analogy. It perfectly clarifies the concept of proportional safety.
So let's start at the lowest level of risk. Imagine you are riding a bicycle down a quiet paved path in a local park.
Okay, nice and relaxing.
Right. Your speed is low, your mass is low. If you hit a bump and fall off, you are going to get hurt. You might scrape an elbow or bruise a knee, but the potential for catastrophic systemic destruction is totally minimal.
You're not going to take down a building on a huffy.
Exactly. Therefore, the required safety cushion is small. A helmet and maybe some elbow pads are completely adequate. That represents a company writing very predictable, low-limit insurance policies. The minimum required capital is low.
Right. The bicycle needs a bicycle-sized cushion.
But now you upgrade. You are no longer on a bicycle. You are driving a four-door family sedan on a major interstate.
Well, the physics of the situation have changed entirely now.
Totally.
You're traveling at 70 miles per hour. You're encased in thousands of pounds of metal. The kinetic energy involved means that a mistake doesn't just result in a scraped knee anymore. It can result in lethal force.
Yeah, a bicycle helmet offers zero protection in this environment.
Zero. So the required safety cushion has to scale up proportionally. You need airbags, three-point seatbelts, crumple zones, anti-lock brakes, a reinforced steel chassis. The regulatory requirement for the vehicle's safety features increases just because the inherent danger of operating the vehicle has increased.
Okay, and then we take the final leap. You aren't in a sedan anymore. You are behind the wheel of a fully loaded 80,000-pound commercial tanker truck carrying flammable liquid, navigating a steep, winding mountain pass in a rainstorm.
The potential for destruction is now just exponential.
Terrifying, honestly.
If that vehicle loses control, it doesn't just harm the driver. It wipes out other vehicles, it destroys infrastructure, it causes massive environmental damage. The safety standards for a family sedan are woefully inadequate for that truck.
So what do the regulators do?
They demand a massive, highly specialized safety cushion. That truck requires pneumatic air brakes, specialized runaway truck ramps on the highway, electronic stability control, and intense continuous driver certifications.
So translating this back to the insurance industry, the companies taking on highly volatile, complex, or massive risks are essentially driving that commercial tanker.
Precisely.
And the NAIC, utilizing this RBC framework, looks at them and says, because you are operating the heavy truck, you are legally mandated to maintain the truck-size financial safety cushion.
It shifts the regulatory focus away from the entity itself and places it squarely on the exposure. You regulate the potential impact of the crash.
Because an insurance crash is bad news for everyone.
Right. In the insurance sector, a crash is an insolvency. And an insolvency means that people who pay their premiums in good faith, who are, relying on that safety net to rebuild their homes after a wildfire or pay for medical care after an accident, are just left with nothing.
That's devastating.
The societal fallout of an insurance company crashing is immense, which is exactly why the safety cushion has to be dynamically tailored to the specific risk profile.
That conceptual framework makes total sense to me, but here is where I hit a wall when trying to apply this to the real world.
Okay, hit me.
Saying higher risk equals more capital is a great philosophical stance, but risk is a nebulous, abstract concept, right?
It can seem that way.
An insurance company is this massive, complex machine made of actuaries, lawyers, investment bankers, and claims adjusters. How do regulators practically quantify danger? They can't just look at a company and guess how risky they are.
No, they definitely don't guess.
Yeah.
The genius of the RBC formula is that it deconstructs the operations of an insurance company into highly specific, quantifiable metrics.
Okay.
The NAIC essentially feeds the company's financial statements into a massive mathematical model.
Right.
And to do this, they categorize a company's exposure into 4 distinct pillars of risk.
Let's pull these pillars apart because I know for anyone studying for a CPCU exam, this is exactly where the granular questions will come from. What is the first pillar the regulators look at?
The first pillar is underwriting risk.
Okay, underwriting risk.
This is the foundational risk of the insurance mechanism itself.
Hmm.
It's basically the danger inherent in the actual policies the company's putting on its books. At its core, underwriting risk is the mathematical probability that the premiums a company collects today will fall short of the claims they are legally obligated to pay out tomorrow.
So this is heavily dependent on the specific type of insurance product a company decides to sell.
Entirely dependent. Insurance products are not created equal. Actuaries often divide them into short-tail and long-tail lines, as well as looking at catastrophe exposure.
Let's look at the catastrophe exposure first. The source uses hurricane insurance as a prime example here.
Right. So if an insurer writes property coverage heavily concentrated along the Gulf Coast, they're taking on massive underwriting volatility.
Because the claims don't happen smoothly over time. You don't just get one hurricane claim a week.
Right. They might go 6 years collecting premiums with barely any major claims at all. Their financial statements look incredibly strong.
They look like geniuses.
Exactly. But insurance isn't about the quiet years. In year 7, a Category 5 hurricane makes landfall directly over a major metropolitan area.
And everything changes.
In a matter of 12 hours, that company is suddenly facing billions of dollars in structural damage, roof replacements, and total loss payouts. The volatility is extreme. That is high underwriting risk.
That makes sense. What about a long tail line? The source mentions workers' compensation. Why is that considered highly risky? I mean, a workplace injury seems fairly straightforward compared to a hurricane.
It seems straightforward until you factor in time and inflation. Let's say a construction worker suffers a severe spinal injury on the job today.
Okay.
The insurance company is liable for their medical care and a portion of their lost wages. The problem is that the company might be paying for that medical care for the next 30 years.
Oh, wow. I didn't think about the duration.
Right. How does an actuary today accurately predict the cost of specialized back surgery, physical therapy, and prescription medication in the year 2056?
That's basically impossible.
You have to account for medical inflation, changes in legal precedents, and advancements in medical technology that might keep the claimant alive much longer than anticipated. Because predicting the future cost of that claim is so incredibly difficult, the inherent underwriting risk is very, very high.
Are there other examples of that?
Medical malpractice is another one cited. A surgeon makes a mistake, a lawsuit is filed, and it might drag through the court system for a decade. A jury might eventually award a staggering, unprecedented sum that completely blows up the insurer's actuarial models.
So, if a company is heavily concentrated in volatile property lines or long-tail liability lines like workers' comp or med-mal, the RBC formula detects that exposure.
It sure does.
It flags it as high underwriting risk and significantly increases the capital charge.
Correct.
Conversely, if an insurer is just writing standard, predictable auto-physical damage policies in a geographically diverse area where they know exactly how much a dented bumper costs to fix today, and the claims are frequent but small, their underwriting risk is lower.
Exactly. The required capital for that first pillar shrinks or expands based on the mathematical predictability of the specific policies.
Okay, that covers the actual insurance products. What is the second pillar?
The second pillar shifts focus from the liabilities over to the assets. It's investment risk.
Investment risk.
Yeah, and this is an area that people outside the financial sector frequently overlook when they think about insurance.
Well, let me ask the naive question then. Why is there investment risk at all? If I'm an insurance company and my entire job is to hold money to pay future claims, shouldn't I just take the premiums, lock them in a giant steel vault, and sit on them until a claim comes in? Why play the market and introduce risk?
If you lock the premiums in a steel vault, you are basically guaranteeing that you will lose money over time. You are ignoring the silent killer of capital, which is inflation.
Oh, right, because a dollar today isn't worth a dollar tomorrow?
Exactly. If you collect $1,000 in premium today for workers' comp policy and you put it in a vault, in 20 years, that $1,000 will have significantly less purchasing power. It might only buy $500 worth of medical care.
But your obligation to pay the medical bill hasn't decreased.
Not at all.
Yeah.
So an insurance company is practically forced to invest the premium dollars they collect. They have to generate a return that at least outpaces inflation and ideally generates a profit for their shareholders or surplus for their policyholders.
So they are essentially massive institutional investors behind the scenes.
Massive.
Okay.
But obviously, how they choose to invest that money matters to the regulators.
It must matter immensely.
It does. The RBC formula aggressively scrutinizes a company's investment portfolio. Every single asset class carries a specific capital charge assigned by the NAIC.
So not all investments are treated equally.
Far from it. If a company's investment officers decide they want to chase massive yields, they might take those premium reserves and pour them into highly speculative tech startups, unrated municipal bonds, or low-grade corporate debt, what we often call junk bonds.
Right.
These assets offer high returns precisely because there's a significant statistical probability that the underlying entity will default and the asset will become worthless.
So if the insurer's portfolio is heavily weighted with these risky assets, their investment risk score just skyrockets.
Yes. The regulators look at that and say, you are gambling with the policyholder's safety net. If the market crashes, the money to pay claims vanishes. Therefore, you must hold a massive amount of extra capital in reserve to prove you can survive a severe market downturn.
It creates a fascinating internal tension within the company, doesn't it? The investment department is incentivized to chase higher yields to boost profitability, but the risk management department knows that every risky asset they buy incurs a capital penalty from the RBC formula.
It is a constant daily balancing act. And on the other end of the spectrum, if an insurer parks their premiums in ultra-safe, highly liquid assets like short-term U.S. Treasury bonds, the yield is very low, but the asset is practically guaranteed to be there when a claim needs to be paid.
So the capital charge for that is low.
Very low. The NAIC assigns a tiny capital charge to those safe assets. The investment risk pillar essentially quantifies the greed of the investment department and penalizes it mathematically.
Okay, so we have the policies they write and the assets they hold. What is the third pillar?
The third pillar is credit risk, and this is primarily about the danger of counterparty default.
Counterparty default. So wait, this isn't about the policyholder failing to pay their premium?
No, this is about other massive financial institutions failing the insurance company.
Oh, interesting. Precisely who?
Well, no insurance company operates in a vacuum. The most significant source of credit risk comes from the reliance on reinsurance.
Okay, let's define that really quick.
Reinsurance is, simply put, insurance for insurance companies.
Got it.
If a primary insurer takes on a massive risk, say, covering a billion-dollar commercial airline fleet, they don't want to hold all that exposure on their own books. They will cede or transfer a large portion of that risk to a massive global reinsurer.
Okay.
The primary insurer pays the reinsurer a premium, and in exchange, the reinsurer promises to cover a portion of the claims if the planes actually crash.
That seems like a smart move. They are diversifying their exposure. Why would regulators view that as a risk? The primary insurer just offloaded the danger.
They offloaded the underwriting danger, but they inherited credit danger.
Ah.
The primary insurer is still the entity that has a legal contract with the airline. If a catastrophic event occurs, the primary insurer is legally obligated to cut a check to the policyholder.
Right, the airline doesn't care about the reinsurer.
Exactly. The primary insurer assumes they can just turn around and collect the reimbursed funds from their reinsurer. But what if that catastrophic event was so massive that it bankrupted the reinsurer?
Oh, man. You thought you had a safety net, but when you fell, the net just snapped.
Exactly. The reinsurer defaults. The primary insurer is left holding the bag. They still have to pay the airline, but the millions of dollars they were counting on from the reinsurance treaty simply don't exist anymore.
And the RBC formula anticipates this.
It does. It looks at who the insurer is doing business with. If a company relies heavily on uncollateralized reinsurance from offshore entities with questionable financial strength, the RBC formula imposes a heavy capital charge.
Because they're basically banking on a shaky promise.
Right. It has to account for the probability that those counterparties might vanish when they are needed most.
It extends beyond just reinsurers, too, right?
Yeah, it applies to any entity that owes the insurer money. For example, large insurance brokers or managing general agents often collect premiums from the public on behalf of the insurer.
Okay.
The broker holds those funds temporarily before remitting them. If a massive brokerage firm goes bankrupt while holding millions of dollars of the insurer's premiums, the insurer takes a financial hit. That counterparty exposure is all quantified under credit risk.
Wow, okay. So that brings us to the fourth and final pillar. What is this catch-all category?
The fourth pillar is operational risk. And this was actually added to the RBC framework a bit later, as regulators realized that companies face existential threats that honestly have nothing to do with bad underwriting or market crashes.
Really? Like what?
Operational risk encompasses the friction, failures, and dangers inherent in the day-to-day administration of a massive financial enterprise.
Give me some concrete examples of what triggers operational risk.
The most prominent modern example is cyber risk. Insurance companies hold vast repositories of highly sensitive personal and financial data.
Oh, of course, hackers.
Right. A sophisticated ransomware attack could lock down their entire claims processing system for weeks, or result in a massive data breach that triggers hundreds of millions of dollars in regulatory fines and class action settlements.
What about internal stuff?
It includes that, too. Severe embezzlement by executives, catastrophic administrative errors that violate state compliance laws, or systematic internal fraud. It is the risk that the machine itself breaks down from the inside.
So looking at these four pillars laid out, underwriting, investment, credit, operational, what strikes me is how they must interact. I mean, the RBC formula isn't just grading four separate tests. It is evaluating a complex ecosystem.
What's fascinating here is that you've just touched on one of the most sophisticated mathematical aspects of the RBC formula, which is known as covariance.
Covariance. Okay, explain that.
Regulators don't simply calculate the capital charge for underwriting risk, add it to investment risk, add it to credit risk, and just get a total sum.
Why not? That seems like the logical way to do it.
If they did that, the capital requirements would be so absurdly high that literally no insurance company could afford to stay in business.
Why is simple addition flawed, though?
Because it assumes the absolute worst-case scenario across every single pillar is going to happen on the exact same day.
Oh, I see.
It assumes that on a random Tuesday, A Category 5 hurricane destroys the coast, the stock market completely crashes, your primary reinsurer goes bankrupt, and you suffer a massive cyber attack simultaneously.
That would be a very bad Tuesday.
Apocalyptic. The mathematical probability of all those independent, uncorrelated events triggering at the exact same moment is astronomically low. The risks don't perfectly correlate.
A hurricane doesn't cause a cyber attack.
Exactly. So the RBC formula uses a mathematical principle called the square root rule to adjust for covariance. It essentially provides a discount to the total required capital because it acknowledges that these risks are at least partially independent.
Okay, that makes sense. Give him a little break in the math.
However, and this is a big however, if a company makes decisions that tightly correlate their risks, the formula punishes them.
How would a company correlate their risks?
Imagine an insurer that exclusively writes earthquake coverage in California. That is massive underwriting risk.
Right.
Now imagine that same insurer decides to invest all of its premium reserves into real estate development projects in California.
Oh, wow. That's a terrible idea.
Right. An earthquake hits. Their underwriting losses go through the roof because they have to pay out thousands of claims.
And at the same time,
Simultaneously, the real estate they invested in is reduced to rubble, meaning their investment portfolio crashes at the exact moment they need to liquidate assets to pay claims.
they just blew up their own safety net.
Exactly. By correlating their underwriting risk with their investment risk, they have created an existential threat. The RBC formula detects that correlation and removes the covariance discount, driving their required capital exponentially higher.
That is brilliant. It forces the company to diversify not just within a pillar, but across the pillars.
Yes.
Okay, before we move into a practical application of all of this, I want to clarify some terminology that is critical for anyone facing a multiple choice question on this topic.
Sure, let's do it.
We keep throwing around the terms required capital and available capital, which is also sometimes called surplus. Can you definitively map the relationship between these two numbers?
Yeah, it is the hinge upon which the entire regulatory system swings.
Okay, define required capital first.
Required capital is the output of the RBC formula. It is the theoretical number that the NAIC's math says an insurer should hold, based on their specific risk profile across those four pillars. Think of it as the regulatory finish line.
So it's what the math demands.
Yes. Now, available capital or statutory surplus is reality.
Okay.
It is the actual, tangible financial cushion the company currently has in the bank, sitting in reserves above and beyond what they strictly need to pay their known claims.
Got it. So how do regulators use those two numbers?
The entire regulatory mechanism is based on the ratio between those two numbers.
Yeah.
Regulators take the available capital and divide it by the required capital to generate an RBC ratio.
Let me do a quick mental check. So if a company's formula says they have a required capital of $100 million based on their risk,
And they actually have $300 million of available capital in the bank.
then their ratio is massive. They have 3 times the required safety net.
Precisely. The regulators look at that ratio and give the company a clean bill of health. They are highly solvent. The company has significant financial flexibility.
But what if things go poorly?
Well, if that available capital starts shrinking, maybe they have a bad year of claims, or their investment portfolio takes a big hit and it drops down to, say, $110 million, the ratio compresses.
They're suddenly hovering dangerously close to the required capital line.
Exactly. And that is when the alarms begin to sound at the State Department of Insurance.
Okay, we have established the theory, the pillars, and the math. Here's where it gets really interesting, I think. Let's take this out of the theoretical realm. Let's look at how this math actually dictates the behavior of corporations.
I love real-world applications.
Let's build a scenario. I'm going to construct a tale of 2 entirely hypothetical insurance companies, and I want you to walk us through how the RBC framework would judge and penalize them.
Let's run the diagnostic.
We will start with Company A. Company A is aggressive. They are headquartered in Florida, and their entire business model is selling homeowners insurance along the coastal barrier islands.
Okay, so highly concentrated right in the historical path of major hurricanes.
Exactly. And on the investment side, their chief investment officer is aggressively chasing yield. They take the premium dollars and invest heavily in volatile tech equities and low-grade, high-yield corporate bonds.
Very risky.
Yes. And finally, the executive team is overconfident. They believe their pricing models are flawless, so they decide to retain almost all of their risk. They purchase very little reinsurance, choosing to keep the premiums rather than share them with a global reinsurer.
That is a highly aggressive, deeply concentrated risk profile.
Now let's contrast that with Company B. Company B is the tortoise to Company A's hare.
Okay.
They sell standard, run-of-the-mill, private passenger auto insurance. They operate nationwide, meaning their policies are spread across all 50 states.
Very spread out.
Their investment strategy is exceptionally conservative. The vast majority of their portfolio is parked in high-quality U.S. government bonds and highly rated municipal debt.
Safe and steady.
And they are cautious operators. They purchase massive, multi-layered catastrophe reinsurance treaties to ensure that if a freak event happens, like a massive, multi-state deep freeze that causes a surge in auto accidents, a reinsurer is standing behind them to absorb the shock.
The contrast is perfect for illustrating the RBC mechanics. Let's look at how the regulatory math processes Company A first.
Let's do it.
Their underwriting risk is astronomical. By concentrating their property exposure in a single catastrophe-prone geographic zone, they are guaranteeing that when a loss event happens, it will be a systemic shock to their balance sheet.
Right, because one storm hits everyone.
Yes, one storm could trigger tens of thousands of total loss claims in a 48-hour period.
It's like the commercial truck driving on an icy road with no guardrails.
Exactly. Then the formula evaluates their investment risk. Again, astronomical. Junk bonds and volatile equities are prone to massive price swings.
So if things go south in the economy.
Right. If the broader economy enters a recession precisely when a hurricane makes landfall, Company A is forced to liquidate their investments at a massive loss just to generate the cash to pay the claims.
Double whammy. What about the third pillar for Company A?
The formula looks at their credit risk. They don't have much counterparty risk because they didn't buy reinsurance. But because they didn't buy reinsurance, they are retaining 100% of that massive underwriting risk.
So what's the final verdict for Company A?
The RBC output for Company A will demand a fortress-like required capital cushion. The regulators will look at their operations and mandate that they hold a tremendous percentage of their available capital in reserve simply to maintain their license.
Because if they don't, the mathematical probability of them going bankrupt and leaving thousands of Florida homeowners stranded is just unacceptably high.
Exactly.
Okay, let's run the diagnostic on Company B, the national auto insurer.
Company B's underwriting risk is low and heavily diversified. A severe hailstorm in Texas that totals 1,000 cars has absolutely no impact on their policyholders in Oregon.
Right.
Auto claims are generally smaller, highly predictable, and processed quickly. They lack the catastrophic volatility of coastal property.
What about their investments?
Their investment risk is minimal. U.S. Treasuries carry an NAIC capital charge of practically zero because the likelihood of the U.S. government defaulting on its debt is considered negligible.
And their use of reinsurance.
That radically transforms their profile. While they introduce a small amount of credit risk by relying on the reinsurer, they successfully transfer a massive portion of their extreme underwriting risk off their balance sheet.
So their final score.
The RBC formula looks at Company B and calculates a significantly lower required capital threshold. Their operations are stable, predictable, and structurally buffered against shocks.
This brings us to a crucial insight from the source material that I really want to ensure every listener fully absorbs. The capital requirement is divorced from the sheer size of the company.
It absolutely is.
I mean, it is entirely plausible that Company A, the Florida hurricane insurer, could be a significantly smaller company in terms of total employees or total premium volume than Company B, the massive national auto insurer.
Yep, very possible.
But because Company A's risk density is so extreme, the RBC formula might demand that they hold a much larger absolute dollar amount in reserve.
That is the paradigm shift from the era of fixed capital. Under a static system, a larger company might just pay a higher flat fee. Under RBC, the riskier company pays the heavier capital penalty.
The regulation scales to the behavior, not just the footprint.
Exactly. It forces the company's executive team to internalize the cost of their risk appetite.
Let's dig into that internalization. Let's look at the ripple effects of this math. Because an insurance company isn't an academic exercise, it's a profit-seeking business.
Very much so.
Suppose I am the CEO of Company A. The state regulators just sent me my annual RBC calculation. My required capital has spiked because I took on too much concentrated coastal risk, and my available capital dropped because my junk bonds underperformed.
Not a good day at the office.
A terrible day. I am now hovering dangerously close to the regulatory tripwire. The alarms are flashing yellow. What can I practically do about it? How does the math force my hand in the boardroom?
It absolutely forces your hand, and usually in ways that are pretty painful for the business. When an insurer needs to improve their RBC ratio, they essentially have three strategic levers they can pull, as outlined in the source text.
Let's walk through the levers. What is option number one?
The most direct lever is to build more available capital. You need to increase the numerator in the equation.
How do you do that?
The primary way an insurance company generates more capital organically is to raise premiums. You charge your customers more for the exact same coverage. This accelerates cash flow into the company, plumps up the surplus, and improves the ratio.
But that is incredibly difficult to execute in reality, isn't it? I mean, if I suddenly file for a 40% rate increase on Florida homeowners policies, my policyholders are going to revolt and seek coverage from my competitors.
Oh, absolutely.
Furthermore, I can't just change the price on a whim. I have to submit that rate increase to the State Department of Insurance and justify it actuarially.
You've hit on the exact friction of that lever. Insurance is a highly regulated, highly competitive market. Price elasticity is real.
So people will just leave.
Yeah, if you raise rates aggressively, you lose market share to competitors with healthier RBC ratios who can afford to price more competitively. And the regulatory approval process for rate hikes can take months or be denied entirely for political reasons. Raising premiums is a slow, heavy lever to pull when you are facing a capital crunch.
Okay, so if I can't easily raise the numerator, I have to shrink the denominator. I have to reduce my required capital. What is lever number two?
Lever number two is to fundamentally reduce your risk exposure. You alter your underwriting strategy to shed the volatile policies that are driving up your capital charge.
Okay, what does that look like on the ground?
If writing coastal property in Florida is demanding too much capital, you simply stop writing it. You issue non-renewal notices to thousands of current policyholders. You withdraw from certain high-risk counties, or perhaps you exit the state entirely. You purposefully shrink your footprint to align with the capital you actually have.
You know, this is the exact mechanism driving the headlines we see constantly.
Right, the market withdrawals.
Yeah, when major household name insurance carriers announce they are abruptly halting all new business in a state prone to wildfires or hurricanes, the public narrative is often that the company is just being greedy or punishing the residents.
That's usually the spin on the nightly news.
But looking at it through the lens of RBC, it's not a malicious choice. It is often a mathematical mandate. The solvency formula is telling them that they literally lack the legal capital required to sustain that level of risk.
Exactly. It is a survival mechanism dictated by the regulatory framework. If the math says a policy is too capital intensive to hold, the company has a fiduciary and legal obligation to shed it. They are prioritizing the solvency of the entire company over maintaining a presence in a specific, highly volatile market.
Which leaves us with a third lever. Let's say I don't want to abandon my market and I can't raise my prices. What is lever number three?
The third lever is risk transfer. You utilize the reinsurance market.
Like Company B did.
Right. If your underwriting risk is too high, you construct a massive reinsurance treaty. You pay a global reinsurer a significant portion of your premium revenue, and in exchange, they legally assume the liability for those catastrophic losses.
And how does that help the math?
By offloading the risk to a third party, your required capital drops immediately, improving your RBC ratio without having to cancel policies or alienate your customers.
But as we discussed earlier, that introduces credit risk, and it cuts deeply into your profit margins because you're paying the reinsurer for that privilege.
It is always a trade-off. Every strategic move an insurer makes to manipulate their RBC ratio has a cost, whether it is lost market share, reduced profitability, or increased counterparty exposure. The RBC system forces the executive team to constantly weigh those costs against the mandate of solvency.
I want to take a step back and center this entire complex conversation on the person who ultimately matters most, the policyholder.
Okay, good idea.
We've spent the last half hour talking about capital charges, covariance, and global reinsurance treaties. But why does any of this matter to the everyday person whose only interaction with insurance is paying a monthly premium for their car or their house? Why is this massive regulatory apparatus so crucial to society?
Because the entire concept of insurance is based on an intangible promise.
A promise?
Yeah. When you buy a policy, you aren't buying a physical good. You are trading your hard-earned cash today for a piece of paper that promises that if the worst moment of your life happens tomorrow, your house burns to the ground, you cause a fatal car accident, your business is destroyed by a tornado, the insurance company will be there with the financial resources to make you whole.
And RBC secures that promise.
RBC is the invisible architecture that ensures that promise isn't a lie. Adequate capital ensures that when a massive catastrophic event destroys an entire community, the insurers actually have the liquidity to pay the claims.
If that architecture fails, if a company operates without sufficient capital and an event wipes them out, what is the practical sequence of events? The source material paints a pretty grim picture of an insurer sliding into insolvency.
It is a slow-motion disaster that inflicts profound pain on the public.
Walk us through it.
The first symptom of an undercapitalized insurer is a severe degradation in claims handling. The company realizes they don't have enough cash to meet their obligations, so they start playing defense.
Defense meaning stalling.
Yes. They intentionally delay claim payments. They request endless, unnecessary documentation. They lowball estimates and force policyholders into prolonged litigation, hoping the policyholder will simply give up or settle for pennies on the dollar.
For a family living in a cramped hotel room because their home was destroyed by a fire, a deliberate 6-month delay in receiving their claim check is economically devastating.
Completely devastating.
And if the bleeding doesn't stop, the regulators eventually step in.
Yes, and if we connect this to the bigger picture, this is where the early warning system aspect of RBC becomes critical. Regulators do not want to wait until the company's bank accounts are totally empty.
So they have alarms in place.
Right. The NAIC has established specific statutory action levels based on the RBC ratio. Think of it like a series of tripwires.
Walk me through exactly how those tripwires work. What actually happens when a company crosses the line?
Let's visualize the RBC ratio as a dial. When the dial is high in the green, the company has plenty of available capital compared to their required capital. The regulators review the annual filings and basically leave the company alone.
Business as usual.
But if the dial drops to a specific threshold, say 200% of the minimum requirement, it trips the first wire. And this is the company action level.
Company action level, what does that mean practically?
The regulators issue a formal demand. The company's executives must draft and submit a comprehensive financial plan explaining exactly how they got into this mess and detailing the specific strategic levers they're going to pull, raising capital, shedding risk, buying reinsurance to fix the ratio.
So at this stage, the company is still in control, but they are on a tight leash. They have to prove they have a plan.
Exactly.
What if the plan fails and the dial drops further?
Then they hit the regulatory action level. The leash gets much, much shorter. The state insurance commissioner now has the authority to issue binding corrective orders. They can force the company to halt writing new business, mandate changes in the executive suite, or restrict the company's ability to invest in certain asset classes. The state is now actively dictating the company's operations.
Wow, they just step right in. And if the financial deterioration accelerates, say a massive storm hits right as they were trying to recover.
They cross into the authorized control level and eventually the mandatory control level.
Mandatory control sounds ominous.
It is. At this point, the mathematical reality is that the company is functionally insolvent, or imminent failure is unavoidable.
So what happens then?
The regulators do not gently guide the company anymore. They execute a legal takeover. The state insurance commissioner petitions a court to place the company into receivership.
What does receivership practically look like?
It is a total loss of corporate autonomy. The state regulators physically walk into the headquarters, change the locks on the doors, freeze the bank accounts, and strip the executives and the board of directors of all their power. The state just takes control of the assets.
Unbelievable. What's the goal at that point?
They will attempt to rehabilitate the company if possible, perhaps by selling off massive blocks of policies to healthier competitors.
Right.
But if the financial hole is too deep, they move to liquidation. They completely dismantle the company, sell off every remaining asset, and use the proceeds to pay off as many outstanding claims as possible.
If the company is liquidated and there isn't enough money to pay the policyholders, who steps in? Are those people just out of luck?
They aren't entirely out of luck because the system has one final ultimate safety net, and these are the state guarantee funds.
State guarantee funds, how do those work?
Every insurance company operating in a state is required to pay into a collective pool. If one company fails and is liquidated, the state uses that collective pool of money to pay the outstanding claims of the failed company's policyholders.
Wait, so the healthy companies end up footing the bill for the reckless company that failed?
Exactly. Which is precisely why every insurance company deeply supports the strict enforcement of risk-based capital.
Ah, of course.
Yeah. They don't want to be financially assessed to clean up the mess of a competitor who took on too much underwriting risk or gambled in the bond market.
That makes perfect sense. They want everyone playing by the rules so they don't have to pay for someone else's mistakes.
Right. But guarantee funds are really a mechanism of last resort. They often have strict statutory limits, meaning they might only pay up to $300,000 for a claim, even if the house was worth $1 million.
Ouch.
And the process of getting paid through a liquidated company and a guarantee fund can take years.
So you really don't want it to come to that.
No. The entire purpose of the RBC framework is to act as that early warning system, triggering regulatory intervention at the company action level or regulatory action level long before the catastrophe of receivership and liquidation becomes necessary.
It is proactive regulation designed to engineer a soft landing rather than conducting an autopsy on a shattered financial institution.
That's a great way to put it.
It also seems evident that this mathematical framework, just by existing, shapes corporate culture. It isn't merely a punitive system, it actively incentivizes disciplined behavior.
The source material highlights this exact point. Because the RBC formulas are public and known, insurers can model the capital consequences of their decisions before they make them. It weaves risk management into the daily operational fabric of the company.
Give me an example of that.
Well, an ambitious underwriting executive might want to insure a massive, highly risky infrastructure project because the premium revenue would look fantastic on their quarterly report.
Sure, looks good for a bonus.
Right. But before they can sign the contract, the internal risk management team will run the RBC calculation. They will look at the math and say, we cannot authorize this policy. The capital charge it generates under the underwriting risk pillar will push our entire corporate RBC ratio down to the regulatory action level.
The guardrails are built right into the decision-making process. The math prevents the bad decision from being made in the first place.
It forces diversification. It punishes concentration risk. It mandates that if an insurer wants to act aggressively, they must pre-fund that aggression with massive amounts of tangible capital.
I want to pivot the conversation now. If you are listening to this deep dive as part of your preparation for a professional designation, particularly the CPCU exams, this specific segment is for you.
Pay attention here.
Because RBC is the bedrock of solvency regulation, it is an inescapable focal point in the curriculum. The source material specifically notes that this framework is heavily tested in CPCU 520, which covers insurance operations, and CPCU 530, which dives into business law and regulation.
If you are sitting for those exams, you will be tested on the mechanics, the philosophy, and the application of RBC. No question.
So let's construct a rapid-fire review to cement these concepts. I am going to pose the most common foundational exam questions outlined in the text, and I want you to provide the concise, definitive answer that a student needs to have locked in their memory.
I'm ready. Let's run through them.
Question 1. What is the primary overarching purpose of risk-based capital?
To serve as a dynamic early warning system that allows state regulators to identify financially deteriorating insurers and intervene before insolvency occurs, ultimately protecting the policyholder.
Perfect. Question 2. Which organization is responsible for developing and maintaining the RBC framework?
The NAIC, the National Association of Insurance Commissioners.
Got it. Question 3. What is the mechanical trigger that occurs when an insurer's available capital falls below their required capital threshold?
It immediately triggers statutory regulatory action. The severity of the intervention escalating from requiring a remediation plan to full regulatory receivership is directly tied to how far the ratio has fallen below the requirement.
Excellent. Question 4. How does the philosophy of RBC fundamentally differ from the historical fixed capital requirement?
A fixed capital requirement applies a static, universal dollar amount to all companies, regardless of exposure. RBC is a dynamic calculation that scales the required capital proportionally to the specific underwriting, investment, credit, and operational risks assumed by the individual insurer. Higher risk equals more required capital.
Fantastic. Now we are going to move to the most critical part of exam preparation. We are going to deconstruct the traps.
Oh, the traps are where students lose the most points. Let's break them down.
Multiple choice exams in the insurance industry are notorious for presenting statements that sound logically plausible or that use familiar terminology but contain a fundamental, fatal flaw. I'm going to act as the tricky examiner. I will present a common misconception highlighted in the text. I want you to dismantle the statement and explain exactly why the logic fails.
Bring it on.
Trap number 1, true or false? Risk-based capital is a highly effective metric utilized by regulators and investors to measure an insurance company's profitability and operational efficiency.
That statement is completely false. And it is a trap because it conflates two entirely different financial concepts.
Right.
RBC has absolutely nothing to do with profitability, and it does not measure operational efficiency. RBC is exclusively a metric of capital adequacy and solvency.
Why is that distinction so important for someone to remember?
Because a company's profit and a company's solvency can move in completely opposite directions.
Oh, so?
Imagine an insurance company that decides to aggressively slash its prices. They are selling policies for half the price of their competitors. Because their prices are so low, they sell millions of policies. Revenue explodes. In the short term, their financial statements might show incredible growth and perceived operational success.
So they look super profitable.
Yes. But because they are underpricing their risk, they are functionally insolvent. When the claims start rolling in, the premiums they collected won't be enough to cover the losses.
Right.
Conversely, an insurance company can have a terrible year. They can suffer heavy underwriting losses, their stock price can plummet, and they could report a massive net income loss for the quarter. They are highly unprofitable.
Okay.
However, if they maintained a massive reservoir of available capital that still vastly exceeds their RBC required capital, they are entirely solvent in the eyes of the regulators.
So profitability is a measure of making money. Solvency is a measure of surviving disaster. The regulators only care about survival.
Exactly.
Trap number 2, true or false? To ensure a fair, competitive, and level playing field, the RBC framework mandates that every insurer operating within a specific state must hold the exact same amount of capital.
False again. This trap tries to appeal to our sense of fairness and equality. But as we discussed with the vehicle analogy, equality of capital is incredibly dangerous when the risk profiles are unequal.
Right, handing everyone the same small backpack.
Exactly. The playing field is not leveled by demanding the same amount of money from everyone. The playing field is leveled by applying the exact same mathematical formula to everyone.
Ah, that's a great way to think about it.
The required capital depends entirely on the risk profile. A massive national life insurer investing in safe treasuries might require less capital as a percentage of their operations than a small, hyper-concentrated property insurer in a coastal state investing in junk bonds.
That heavy commercial trunk always needs a bigger safety cushion than the bicycle, regardless of what state they are driving in.
Uniformity of the formula, not uniformity of the capital amount.
All right, the final trap. And this one is insidious because it plays on the innate human desire for absolute safety. True or false? Because of the strict mathematical formulas and continuous monitoring of the RBC system, state regulation practically guarantees that an insurance company will never fail.
Emphatically false. And understanding why this is false is crucial not just for passing an exam, but for understanding the limitations of the global financial system.
Okay, why is it false?
RBC is an incredibly sophisticated early warning system. It is highly effective at catching companies that are slowly bleeding to death from poor management, bad pricing, or risky investments. It allows regulators to intervene and manage the decline.
Right,
But it's a safety net, not an impenetrable force field. It does not and cannot guarantee that an insurer will never fail.
because insurance inherently deals with the unpredictable future.
Precisely. The RBC formulas require capital to buffer against modeled statistical probabilities. But the real world occasionally produces events that completely defy historical modeling.
Things we've literally never seen before.
We call these black swan events. If an unprecedented 1 in 10,000 year disaster occurs, a massive asteroid strike on a major metropolitan economic hub, a global pandemic with a mortality rate far exceeding historical models, or a synchronized global collapse of the financial markets, the sheer volume of instantaneous losses could easily dwarf even the most robust RBC requirements.
The math prepares you for the worst-case scenario that we can imagine. It cannot perfectly prepare you for the worst-case scenario that we haven't conceived of yet.
RBC mitigates risk to a highly acceptable societal level. It does not eliminate the existential possibility of a catastrophic, system-breaking shock.
I think we have thoroughly neutralized the traps. If you are listening to this on your commute to the testing center, block out the noise and remember the core philosophy. RBC equals dynamic, risk-sensitive solvency regulation.
Keep that in mind and you'll do fine.
I want to take a moment to commend you, listener, for navigating the dense, complex architecture of solvency regulation with us today. We have covered a tremendous amount of ground.
We really have.
We started with the failures of the fixed capital era, We explored the mandate of the NAIC. We dissected the four pillars of underwriting, investment, credit, and operational risk. We walked through the strategic levers a CEO must pull to survive, and we looked at the grim reality of regulatory receivership.
It's a lot to take in, but it's foundational.
To bring this comprehensive deep dive to a close, I want to ask you to distill this down. If the listener retains only a single foundational concept from this hour-long exploration, what must it be?
It all comes back to the mathematical heartbeat of the entire framework. Risk up, capital up.
Risk up, capital up.
That is the immutable law of modern insurance regulation. The greater the risk an insurer chooses to assume, whether that is writing highly volatile catastrophe policies under the underwriting pillar, gambling on speculative equities under the investment pillar, or relying on uncollateralized counterparties under the credit pillar, the more tangible available capital they are legally mandated to lock away in reserve.
It's just a direct correlation.
Yes. This system, developed and refined by the NAIC, is not merely bureaucratic red tape. It is the fundamental structural architecture that ensures promises are kept, policyholders are protected, and the broader economy remains stable when disasters strike.
Risk up, capital up. The concept is elegant in its simplicity, even if the execution requires a supercomputer to process the covariance models.
It is elegant. But this actually raises an incredibly important question, and this is the thought I want to leave you with to ponder long after this deep dive concludes.
Oh, leave it on us.
We have established that the brilliance of RBC is that it mathematically models risk. But every actuarial model, by definition, is constructed using historical data. It analyzes how the world behaved in the past to predict the required safety cushion for the future.
Okay, I see where this is going.
But what happens when the future no longer resembles the past?
That is the defining problem of our era, isn't it?
Think about the rapidly shifting risk landscape we are currently navigating. We are observing severe changes in climate and weather patterns, generating storms of a frequency and intensity that simply do not exist in the historical data sets that the RBC formulas rely on.
So the models might just be wrong.
Exactly. And we are witnessing the emergence of entirely novel, unquantified risks. Consider the potential for a global systemic cyber warfare or massive operational failures driven by autonomous AI systems.
We don't have historical data for AI.
Right. We do not have 100 years of historical claims data to accurately model the capital charge for a localized AI failure that cascades into a national infrastructure shutdown.
That's terrifying.
If the RBC mathematical models remain anchored to the historical data of the 20th century, how will state regulators need to aggressively adapt and overhaul these formulas to ensure that the early warning system actually triggers in time to prevent the insolvencies of the 21st century?
Wow.
If the fundamental nature of risk is evolving exponentially, how quickly can the regulatory math catch up?
It is the Everest problem all over again, but with a terrifying twist. The RBC formula provided us with the perfect gear to climb the mountain based on what the weather on the mountain looked like for the last 100 years.
Yes.
But if the mountain is suddenly transforming into an active volcano while we are climbing it, the historical gear isn't going to save us. The regulators, the actuaries, and the industry are going to have to redesign the backpack while the hikers are already traversing the ridge.
That is the perpetual, unending challenge of regulation. The system is never finished. It must constantly evolve to meet the reality of the threat.
And on that incredibly provocative, slightly terrifying note, we are going to wrap up today's session.
Thanks for having me.
Thank you for dedicating your time to joining us on this deep dive. Whether you are walking into a CPCU testing center tomorrow or stepping into an executive board meeting, you now possess the conceptual framework to not only understand the mechanics of risk-based capital, but to articulate exactly why it is the bedrock of the industry.
You've got this.
Keep studying the models, keep questioning the underlying assumptions, and remember, always check the size and the contents of the backpack before you attempt to cross the river. We will catch you on the next deep dive.